Hey everybody, Jared Jones. Today we're going to talk about the 2021 winners and losers across the market. Let's get started. 2021, we're going to talk about several market sectors. And to start things off, let's talk about the Fed. The central banks have been pouring cash into our economy through the 2020 COVID situation. You can see by this chart the Federal Reserve puts out, this is a kind of an overview of their balance sheet. You can see at the bottom here, this was 2014. We were hovering into 2014 at around $4 trillion, and we maintained $4.5 trillion in assets there all the way going into 2020. And then with COVID, it spiked. So we're over $7 trillion on this report right now. Economists are crying foul. They're saying like all this money is pouring in to prop up the stock market. It's building up kind of a fake market. And the real concern, obviously, for this is the fact that it just causes inflation. You can already see if you're going to the grocery store over the past 5-6 months, food prices have been climbing. Different goods are costing more. Building materials are costing more. So inflation is an absolute killer. And so as we kind of look at the marketplace, you want to kind of get an idea of how things look. So right here, Fortune magazine has a chart that has been running since early last year when the pandemic hit. And you can see that temporary closures are plummeting and then permanent closures are actually climbing. So the pain is still in the economy. With that being said, it's more than likely that the Federal Reserve, the central banking system, will continue asset purchasing. And so the real concern and the increasing concern is that folks are going to end up hurt as a result. So take a look at states moving in and out. There's some interesting data here. The Postal Service is actually putting out data that tells us where people are moving to. And oftentimes during the pandemic, who's been losing the most occupants and kind of their statistics. Check this out. This, by the way, is net moves. This is total people still in the same place at the end of all the moving, right? So if a bunch of people moved out, a bunch of people moved in, the net difference. So Texas has lost the most residents to moving. New York came in second, Washington, D.C. third, followed by North Carolina and California, Arizona. It goes on down the list. One of the more interesting things that I think the USPS put out is the fact of what's called in-county versus out-of-county moves. Check this out. 90% of all moves are in-county moves. That is incredible. That just shows you that people aren't relocating. You know, the relocation push is just non-existent. There's no need to physically relocate bodies and assets of companies. Like, it's just not happening. So that's really, really an interesting point. I think that points to a pent-up supply, right? So if there's that few people moving from county to county, there's probably going to be a bunch of people that really need to move. The interesting thing about watching the USPS data is that you can actually see where people's money is moving to, okay? In Florida, Orange County particularly, Central Florida, Orlando area, the Bronx, Queens, Brooklyn, and Chicago. Also, Miami is a big importer of new residents. And so, you know, when you're moving your money or you're trying to raise money to invest, it helps to know that you're going to places where there's money going. And the USPS has some great data on that. Pain. Obviously, Biden is coming in. He's installing extensions to a lot of the measures to protect people who live in different properties, from the aspect of moratoriums on evictions. And one of the interesting things is some data that came out in December is that Moody's Analytics said that there's around $70 billion in outstanding debt from tenants. So it kind of equated to like 5,000 or 6,000 per person. By January, 12 million renters would owe around $6,000 in back rent and utilities by January. That is crazy. It's just a crazy number. So obviously, you know, I'm not going to go into unemployment numbers and new unemployment benefit requests, but those are still very big numbers. And you have real people that are behind. And, so kind of summarizing, it seems like a lot of folks that have moved in 2020 didn't go far, right? You also have the vaccine rolling out. And I think the vaccine rolling out rather has the ability to create a lot more movement in the market. There's just a lot of stagnancy from the aspect of there's no supply because sellers aren't coming to the market. And so with that being said, you would expect that there would be a supply bump at some point in 2021. And with the vaccine, with the sense of containment, you would expect some of the safeguards that exist in the mortgage industry to kind of come away. And same thing with evictions. So while there's evictions safeguards on, the mounting debt is being staved off. People are growing how much they owe their landlords. In the mortgage side, you have people that are on 6-month forbearance programs or more. And that number is up there. You have a 5 to 6% forbearance rate. But check this out. Black Knight, and you might have noticed from last year, we actually hit a 21-year mortgage delinquency record. So it was actually a 21-year high for mortgage delinquency. Yahoo Finance, in fact, you can probably find this covered by many other publications. Yahoo Finance came out and documented last year how there was a 21-year high for mortgage delinquency. I mean, you're talking about a big number considering the past of people that just didn't pay their mortgage. We've had some rocky years in residential. But the other thing too, Black Knight, which used to be like a fidelity company who does data, talks about the fact that mortgage delinquencies towards the end of the year, they put out a report December 21 that says despite seasonal headwinds, mortgage delinquencies improved for the 6th consecutive month in November 2020, falling to 6.33%. So coming down from 6.44 from the month prior. The national delinquency rate is now down 1.5% above its peak, which was almost 8% in May. So the interesting thing, as I was saying a second ago, is when the vaccine rolls out, when will the protections end? Okay, so think about this. You've got 6% in forbearance. You've got 6-7% in delinquency right now. You've got 12 million non-paying tenants that are getting behind. You still have major issues. So if you're a non-essential person and you're in a business that closed or you're in financial hurt, a lot of the market right now has underpinning hurt in it that's just stagnant because of cooked in protections from one direction or another. And when the vaccine is rolled out, there's going to be a sense of, now we can back off things. Okay. And they're going to control how that, revision happens. How do we take off, all these protections that exist? So again, we're going to have to watch foreclosures in Central Florida, all throughout the country. There's, things are kind of okay for now. But you've got economic pain underneath. You've got the inflation of what we're buying. So essentially you have an income problem, you have an expense problem because everybody's cost of living is going to increase with inflation because the Fed, it's incredible, propping up the stock market to keep things going. And the middle class is going to get squeezed. And when the safeguards come off, there will be inventory hitting the market because there will be this concept of musical chairs, right? Like I can't really afford what I have. I had forbearance, but now I have to make my payment or I'm going to be in trouble with foreclosure. Do I sell and get my equity back out? Okay. And then move into a multifamily situation or another home that I'm going to rent. In Central Florida, multifamily is going to be in huge demand. Okay. So, kind of getting back to this concept of talking about all the winners and all the losers, you want to break all this down. Saying all that to say this, let's summarize winners and losers. Well, losers. Savers. Savers are losers, in the great words of Robert Kiyosaki. The purchasing power of $1 is going to absolutely hurt the poor and middle class in America. There's no two ways about it. As I showed you earlier on, the Fed's going to continue buying and buying and buying. We are creating a fake market, just like CNBC. I showed you a headline earlier. And with that is going to erode the buying power. So you're going to see I have $1 in the bank today. 15 years from now, it's going to be worth, 20 cents in terms of how much it can purchase. So savers, people that are sitting on their money or they have cash, are going to be in trouble. They're just not going to have enough value because it's absolutely being eroded as we bail out the economy en masse. Retirees living on fixed incomes, super sad, but fixed incomes aren't going to go near as far. Workers on fixed incomes, borrowers on variable rates. That's going to be a little less of an impact, but if you do have a variable rate loan, look out because the indexes will actually adjust those on you. Whole economy from general economic uncertainty is going to be a loser, and exporters that are less competitive are going to be in trouble. Winners. The winners are debtors on fixed payment plans, debtors on installment loans, car loans, house loans. If you're on a debt item, you are going to win huge because the other factors that are inflated by inflationary pressures that cause rents and things to go up, when you have a fixed item, you're going to be in good shape. Governments with high public sector debt is going to be a problem. Owners of land and physical assets, assets that are physical, right? Like gold, real estate, things that have a physical existence to them. Firms who can cut real wages. Firms who can cut real wages. So you're sitting with investments. What do you do? What do you do with your cash? Physical assets. If you're in a rental situation and you can get out of it and you're doing okay financially, get out of the rental situation. Let's talk about real estate for a second. Real estate is going to absolutely skyrocket. I mean, there's going to be a time when things going up will have to come down, but real estate will skyrocket in the short term. The second thing, multifamily is going to skyrocket. There's going to be huge multifamily demand even long after I think the residential market starts to see a correction, because there will be a high need for tenants when they do corrective income structuring and corrective expense structuring. They just got to lower their monthly household bills. So they're going to get out of a house payment or a high rent payment. They're going to have to get into something a little bit less. So affordable multifamily is going to be a huge thing. Data centers, industrial sites, things that are non-street fronting retail operations that fit with where the economy is going right now are going to be great bets to invest in. So with all that being said, I hope this helps you with planning and understanding where the economy is heading in 2021. It's going to be an interesting ride. We'll see you soon.
The market's red hot. Why pay so much to buy or sell your home? The Jones Group will list your home for just 1%. Buy a home, get a $7,000 cash rebate before close. Don't let anyone you know buy or sell without calling us first. Make one call, that's all. Better service, lower fees.